Maverick traders, welcome out to Trading Technicals, and today we're going to explore the advanced decline line. We'll focus on the New York Stock Exchange, but there are a variety of different advanced decline lines. We'll talk about what it is, how it's helpful, how it can confirm a trend, how it can diverge, and give a little bit of a leading indicator that, hey, this is a bearish divergence or bullish divergence. There's something happening here that we need to be aware of. So let's first talk about what the advanced decline line is. The advanced decline line is the number of advancing stocks versus the number of declining stocks. We're going to focus on the New York Stock Exchange, and there are 2,400 companies that trade on the NYSE. So on any given day, there are 2,400 advancers or decliners, right? Now, something could end up exactly flat from where it finished the prior day, but most of the time you'll end up a little, down a little, up a lot, down a lot, and there will be an advance or a decline. This does not measure the magnitude of the advance or the decline, but one would expect that if the market's booming to the upside, in fact today the stock market's up 3-4%, we'll probably look at an S&P chart today. Well, because the market's up so big, of course there are more advancers than decliners in all likelihood with that robust of a market rally. But this is not the S&P 500, right? These are not 500, these are 2,400 stocks. Let's say that on this particular day, hypothetically, you had 1,400 advancers versus 1,000 decliners, right? That's a bullish day net. There were 400 more advancers than decliners. This is a cumulative line, so it takes this figure and then it will, the next figure that comes in, it will add or subtract from that. Let's say that the next day you have maybe, let's switch it up. Let's say 900 advancers versus 1,500 decliners. In that scenario, you would subtract 600 from the prior, so now you're net minus 200 decliners. It's a cumulative number. It takes today's figure against what the cumulative number was, and it keeps going from there, right? And this will, in that case, it went down. If the next day there's more decliners, it would just keep growing. Now there would be minus 400 and decliners and minus 600, and then if you got an advancing number, oh, it came back up to minus 500 total, and it would just trend in certain directions. When there is an extended period, like a couple of weeks, where more stocks are declining than advancing, of course the cumulative numbers, you're going to keep adding more negatives and more negatives. If you have a bull market, you'll keep adding more positives and more positives, and so it runs in that fashion. Now, as we think about this advanced decline line will somewhat trend. Now, I don't think that you really want to go out and say that there's support or resistance or trend lines. We don't chart it like that. This is a gauge. This is basically a gauge of what they call market breadth. Market breadth means how widespread is this advance or is this decline. Sometimes it can be very, very narrow. So in other words, you could have the SPX going up and the advanced decline line maybe supported that and confirmed that early on and is now diverging. Is this possible that the advanced decline line did this while the market, the S&P 500, did this? Absolutely. In this case, because the market was going up but the indicator turned down, they'd call this a bearish divergence. This is a leading signal that, hey, we've got a problem here. Yes, the stock market went up. This is 500 companies, but it's market cap weighted. It's mostly driven by the biggest companies, the big corporations of Apple, Google, Amazon, Microsoft. They're so much more impactful. In fact, the top 10 in the S&P 500 are far more important than the bottom 100, okay? The bottom 100 could go up, and if those 10 go down, the S&P is going down accordingly. So it's not equal spread. See, in the NYSE advanced decline line, all companies out of the 2,400 are equally weighted. It's just one stock's up, one stock's down. This stock's up, this stock's down. They're evenly weighted. The S&P 500 is not like that. It's 500 market cap weighted. So the bigger you are, the more you drive the index, the more impactful you become. So you'll see these divergences. You'll see times where the market goes up, but the advanced decline line goes down. What does that tell us? Actually, most stocks are going down, aren't they? Most stocks, most sectors, most industries have turned lower during this period of time. How did the S&P advance? Well, because the bigger corporations must have kind of pulled extra hard, right? So most things were going down, but these were maybe going up sharply. And so the index advanced, but we know this is a warning sign. Or the opposite could be true. The S&P could go down, the advanced decline line keep going up, and we'd say, hey, most stocks are advancing. Even though those big, heavy, large cap tech names are going down, that's not the true story. So the advanced decline line will give you a little notion of truth in terms of the entirety of the market. If you really want to know whether there's market breadth, whether it's widespread advance or widespread decline, and whether the majority are going up or down, this is a great indicator for doing that. And it's really interesting right now because over the past couple of weeks, what have we seen? We've seen this in the most important stocks. Apple has had a terrible couple of weeks. Amazon, a terrible few weeks. Now they're having a good day today, everything is, but Google, terrible couple of weeks. These are important companies. Microsoft, not so hot. These are impactful, right? Tesla is a big market cap, and they've had it really bad. But guess what? The majority of stocks are actually going up. There's been a divergence. And I did the market roundup on Tuesday, and I talked about this a little bit that, hey, I'm bullish. The market's shedding, it's shaking off a lot of bad news from a lot of different circles. It's been hit by all sorts of things, and it just hangs in there. And most stocks are advancing. You can get a little bit lost thinking that, oh, the market's in trouble if you're just narrowly focused. But if you look at the big picture, you say, actually, most things have been advancing and have been climbing higher. So that's kind of an interesting dynamic that's been in place. So first, I'm going to bring you over to stockcharts.com, and this is a free charting platform. If you go to stockcharts.com, you can put in the symbol $NYAD. $NYAD will pull up the New York Stock Exchange advanced decline line. At first, the chart will be messed up. This is not it. You need to come down to the type of chart, and you need to change it to cumulative. This is very important. If you want to see this chart correctly, you have to come down here and change it to cumulative. Now, as you do that, the chart will display correctly. You'll notice that it puts red and black to kind of show you if it dipped down or went up during that period of time. And basically, each one of these little tiny movements are 1 day. So you can see here, down for a day, up the next day, down for a day, up. But for the most part, it's kind of trending in a certain area because, again, it's cumulative. They're adding those up. So it takes a period of a lot of decliners to get a real trend going, or a lot of advancers to get this moving, because right now we're at negative 467. So we went really super negative down here because it's added to. We got as low as minus 9,000. That tells you that for months, we kept adding more and more negatives to the equation, didn't we? Then we started to add some positives, and so it started to get back. Then we went to negative 8 and 7 and 6. We're still negative 467. So even though we've been advancing for the past few weeks, we're not yet to positive territory and adding those numbers. But you can see this little dip here in the advanced decline line, and now we're up above that. We're still trending higher. Usually traders will overlay this or compare it to another chart. And in this case, I'm going to go side by side S&P 500 and the advanced decline line. And these are on the same time period. And what you'll basically be looking for are little signals and little signs that maybe the market has more underlying strength or weakness than what you can see on the surface, right? We're looking for market breadth. We're looking for, are things going up or down? And here's kind of a good example of that. As the market turned down here recently, you can see that it kind of set a little lower high right here. See how it dropped for 3 days, advanced for 3 days, and then it pivoted, and it just made this little wiggle. Well, did we need to freak out about that? Well, what's interesting about that is during that same time period, the advanced decline line had made a higher high. Do you see how this peak was higher than the prior peak right here, whereas this peak was lower? So what did the S&P do? Well, it got weaker, but what did the market as a whole do? It got stronger. Do you see that little divergence? Now that's a mini divergence, but it's a divergence nonetheless. That basically the market's been stronger than what it appears on the surface if you just look at the S&P 500. The problem for the S&P 500 is it's so heavily weighted to Apple, which has had a rough couple of weeks, to Google, which has had a terrible couple of weeks, to Amazon, which has had a very dreadful couple of weeks, to Tesla, which has been taking it on the chin, and on the list goes. Another way to kind of look at that would be through the heat map. The heat map at FinViz is very instructive because if I come into the heat map, it shows the whole S&P 500, but do you see how big this box is for Apple? Apple has a bigger impact on the S&P than the entire material sector here, than the entire utility sector. Apple's bigger and more important. And by the way, Microsoft is more important than all of the utility sector. Google is just as impactful, that one stock, as the entire material sector. Apple's probably bigger than all of energy combined. Add up Exxon, Chevron, Conoco, all of these companies, they don't equal one Apple in terms of market capitalization. So if energy's all going up, but Apple goes down, it's a net even for the S&P. It's a net non-factor. That's how impactful these are. So as I said, the market looks a little worse than, or looked a little worse the last little bit than it actually was. And that's very important to kind of understand that dynamic here. Now, I do not use the New York Stock Exchange advanced decline line religiously, meaning I'm not sitting here staring at it at all hours of the day or anything like that. But I do like to tap into it to really tell me about the market breadth. Are we advancing? Is it supportive? Are we diverging? And just get a quick little gauge, just get a quick little sense of the market. And sometimes it can be really instructive. If you go back in time, let's go back a year. And, maybe we'll even back it up more than that. Let's go back maybe a year and 8 months or something like that. Let me squeeze this in here. And then we need to have the advanced decline line match up. What I want to show you is how this can be instructive. So just look at the big picture. Don't worry about all the small intricacies of it all, but just look at the big picture. We advanced, all throughout this period we were advancing, right? Advancing, and then the final peak, which was late 2021 into the very start of 2022. This is the stock market. This is the S&P 500, and that's how it performed. Well, interestingly enough, as you look at the advanced decline line during that same time period, we were advancing. We kind of leveled off here during this phase, right? And then the market advanced again. This is in October, November, and we advanced right along with it. So it, when this went down for a month or so, this went down. But look at those peaks, three peaks. Look at this trough, look at that advance in November, and the advanced decline line went right up along with it. So to that point, everything looked fine. But here's where the chart diverged pretty significantly. Look at the time period down here at the chart and look at late December 2021, early 2022. Do you see this clear-cut divergence? The S&P ran to new all-time highs. The advanced decline line was not having it, not even close. The advanced decline line was clearly making a lower high. This is a big divergence, right? Basically, a big warning sign. This is called a bearish divergence that says, hey, don't be misled. Yes, the market went higher. Why did it go higher? Because Apple and Google and Amazon and all of those most important stocks zipped higher and they ramped higher. But the majority of stocks had already started to decline. There were more declining stocks during this month and 2 months or whatnot than there were advancing. So even though the indexes, the Nasdaq, the S&P went up, the majority of stocks were actually going down. Yeah, they're not the big names, but it was telling you something. It was kind of a precursor of sorts, right? A leading indicator. If you look at the declines, when the market starts to make a downtrend, now you're more interested in the declines and what's happening there. And so in these declines, I mean, the advanced decline line kept dropping during this period of time. Okay, we went through a big correction here, so did the advanced decline line. We went and made a new low here, and so did the advanced decline line. Now there was actually a little mini divergence of sorts here. When the S&P went down a little bit lower low, the advanced decline line didn't. It made a higher low. So there was a little mini divergence here. Not as big as this one. This one was a multi-month divergence, right? This is a big long-term signal. This one was a short-term signal, but did the stock market drop to a new low? Yes. We got a little bullish divergence out of the advanced decline line here, a mini one. Okay. Now, what I really want to emphasize, though, is that we're still in this path, that the market has gone to new lows, and so has the advanced decline line. And it's probably a better bet long term. Although I've been bullish in the short term and thought we'd get another push, another, again, the markets in the short term are really shaking off bad news, acting well. The majority of stocks are going up. We're in a correction within an overall bear market. Understand what it is. We're swimming up, but the river is flowing down. The big picture is going down, and the advanced decline line supports that. So my guess is that this rally is going to fade off here in the next couple of weeks. We're going to set a lower high in the S&P. We're going to set a lower high in the advanced decline line. The market will proceed to likely trade to new lows, and it will be very interesting to see if the advanced decline line does or does not do that. My guess is that about the time the market's bottoming out long term, you'll stop seeing stocks decline. Now, the market might make a new low, especially given that a lot of this wreck, a lot of this downturn has been technology related. The tech stocks are somewhat leading the downside charge to a certain extent, and things like energy that have no weight in the S&P, they're very small weighted. I think the entire energy sector maybe is only 4% of the S&P or something like that. But that's what's been leading. Now, the majority of stocks might not make a new low, even as the S&P does, and that would give me much more confidence that we have actually established or are in the process of establishing the bottom, the ultimate bottom, the bottom of all bottoms, where the market proceeds to trade back up in the coming years. Until that time, the bear market is intact and supported and agreed to here. So we've had some little bullish divergences a little bit here in the short term, little trading signals for the short term guy that's going to trade for a couple of weeks to the upside. It's been helpful. It's certainly been pointing towards more upside, but in the big picture, probably going to roll over all over again in the coming weeks ahead. So stay tuned for that. So we'll leave it there. I hope you've enjoyed this class on the advanced decline line. On behalf of Maverick Trading, I'm Corey Halliday. So much fun to be with you, and we'll see you next time. Goodbye, everyone.